nine, eight, seven, six, five, four, three, two, one.
Hi, everyone. We're here with Karen Rands, who's the author of the best-selling book, Inside Secrets to Angel Investing. And she's also the founder of the Compassion Capitalist movement. And so excited to have Karen with us today. Get started. And Karen, can you give us a little bit just a little bit into your background and what led you to write the book, what led you to start the Compassion Capitalist movement?
Okay, sure. Thank you, Laurie. Thank you so much for the opportunity to talk about this with you and share some of my insights, because this is a real passion of mine. And my goal, sort of, just jump to the end, and then I'll come back and how that happened is the Compassion Capitalist movement is intended to bring net new capital into the marketplace so that people will, of all income levels, that have liquidity and ability to, make investments. They're in charge of their wealth creation strategy, and to add investing in entrepreneurs to their portfolio the same way that they think about adding real estate or think about stocks. And once they get to the point where they're trying to be proactive about creating wealth, one of the assets that they need to have in their portfolio, and everybody really in this day and age could have some investment in entrepreneurs in their portfolio. And so that's what the Compassionate Capitalist movement is. The definition of a compassionate capitalist is somebody who invests time, knowledge, resources, and money into entrepreneur endeavors to bring innovation to the market, create jobs, and create wealth. And I expanded that after I came out with the book, because I realized there's so many people that dream of being an entrepreneur. They think about someday we're going to do it. And particularly right now, as we go through another economic flux, people think, oh, so now is the time to start a business. What should I do? I don't know what my future is. And so the idea is that, the number one way to create wealth is to be a successful entrepreneur. Well, lo and behold, which I didn't know until I got involved in angel investing 20 plus years ago, and really came to understand with the crowdfunding movement and the Jobs Act, is that the second way to create wealth is to be an investor in one of those successful entrepreneurs. And the good news about being investors in entrepreneurs is that you can put your money into many different entrepreneurs in different industries and different types of business, different stages of business, and have its own diversification strategy, and not have all the risk of being the founder of that entrepreneur. If you don't have the fortitude, the just whatever, it takes a lot to be a successful entrepreneur. And so now you can be an investor in that. And so that's really the whole purpose and mission behind this. And I originally started the idea of putting it out there as, and I had renamed my podcast to be that during the first recession in 2010, because I saw this money on the sidelines and it needed to get put back into the economy to do that, to create the jobs that we needed to grow our economy. And I didn't really come out as it being a movement until I had an epiphany. I was working through, my dad was in the process of passing, and he had been a very successful entrepreneur in his own right, having invented the first screen printing machine that you could screen print multiple colors, more than two colors on.
Wow.
It's sort of like they called him the grandfather or the godfather of the screen printing industry. And he, and I was going through all of his memorabilia and looking at all this stuff and seeing other things that he had invented. And I realized that he didn't even start that company till he was 50 years old. And I was like, wow, it's not over for me. The recession hit me kind of hard. And I was like, it's not over. If not me, then who to start this compassionate capitalist movement? And the future of our country, entrepreneurism is such a wonderful thing. The empowerment it has. You think about everything that we have around us, somebody invented.
Right.
Somebody invented that. And whether, every company that we have, large, big, small, whatever, it's somebody's entrepreneur spirit that said, I have this idea, I have this thing that I can do different from somebody else. And if I put the right team together, if I get the capital right, then I too can leave a legacy for my family in the marketplace, for other innovation to be built upon. And so it's just all part of what I think that, particularly in America, I mean, to me, America is our entrepreneurism is kind of in our blood.
Right. Yeah.
We're pioneers in all kinds of things, and it's just all, part and parcel to what I'm all about.
Yeah, no, when I read your book, there's sort of if you're working, I think you gave the example of working for a big company, and you've always wanted to be an entrepreneur. You're really not ready for that risk, but you have some money on the sidelines. This is a way, like, for you to, feel that you're part of the entrepreneur movement, because you are like investing and really kind of leading the success of a company that you're passionate about. And that's the whole premise of your book. And I think right now, with the current pandemic and so many layoffs that have happened at even higher levels, I mean, CEOs are getting laid off. And I think there's going to be a resurgence of, startups. I think people are, now maybe people have thought about becoming an entrepreneur and never really, we're in a position, and now their job is eliminated. So now they have to reassess, what they're going to do. And if this was kind of on their, on something they wanted to do, but, never had the opportunity, I think you're going to see a lot more startups coming out of this. And so my next question is, from a startup's perspective, what are the challenges of fundraising? And, you talk about these compassionate capitalists and these angels out there. What's the best way, like, what are the different types of angels? And can you describe that, and, how the startup can access those angels?
Yes. Okay, sure. So the first step that a startup, okay, so you've got this idea that you want to do. And when I have done, my presentations and coaching and workshops and things like this, we kind of go through the details and the very first thing you have to do when you're assessing, before you ask anybody for any money, you have to decide where's your end point. Okay, it's just like you're on a journey of what you're building a company, and you have to have a plan. So whether you're building a house, building a company, you have to have a plan, and you have to know what your end result is going to be. Now, it may change along the way, but you've got to be able to do that, because you also have to assess, how big does this company have the potential to be? How unique is it? Is it a market participant, meaning that there's other companies doing it? So say you're starting restaurants aren't a good example these days, but you got something that, you see something that's a little bit different, but you want to do it a little bit different, but it's not unique. There's other people doing that in the marketplace. And in today's world, and the way you can raise capital, you can still get money to do that kind of a business, but you need to assess, because depending on how big your business is going to be also means what kind of money potentially can come into it. So if it's a market participant that you might, best case scenario, after a couple of years with a single location and you might be making $1 million a year in revenue. Well, you're not going to get your angel investor in something like that, because it's never going to get the return on what it is that they expect on their return on their investment if they're going to put their money to risk. But if it's a kind of thing that has potential to scale in multiple states, or it's innovation that has potential to really wedge into a marketplace or create a whole new marketplace, so it has potential to be $100 million business, if it really, really took off, and you really understood how your customers are going to buy it and the need that you fill in the marketplace, well, now you have the potential to go after that traditional sector of investors that, you start with the friends and family, or investors that subjective investors that believe in you as the founder, or they're just so enamored by what it is that you're trying to do that they're like, I can't believe this. I would do that I would buy that tomorrow. I've been wanting that. I've been needing that. right? There's people that within that industry that see the potential, what it is, without you figuring out all the other, pieces and parts of how you're actually going to do it. And they give you the first money to be able to go out and do that. And then you have to be in a position to raise your big money. I talk about it in the book. I've got podcasts on it and articles, but it's called the Karen Rands theory of private equity. And it's basically creating a funnel. And we can go into this in more depth if you want, but it's creating a funnel that's very similar to the funnel you create for your sales plan. So of who your customers are going to be and how you're going to generate your revenue. Your revenue isn't just a percentage of the marketplace. It is how are you going to engage customers, get them to buy, what are they willing to buy, all that kind of stuff. So it's a very similar strategy when you go after investors. And once you know all the money you're going to need and you start to figure it out, to get to this point, I need $500,000. And then I'm going to be at this point, I'm going to need $5 million. At this point, I'm going to need $20 million to become that $100 million company. Well, then your Series A is a angel group traditionally, right? And then it might go to a small boutique VCs or bigger angel groups that follow on to that. And then you go to venture capitalist firms, and that's your traditional sector that you're going to raise with that. Along the way, we can get into the types of individual angels, or how you do that friends and family, and then the crowdfunding pathways are a whole nother sector, because that one I just described are typical for tech companies, consumer products companies, and other types of services, life sciences companies. Sometimes they follow a different trajectory than your traditional, Series A, Series B, Series C that goes to the venture capital marketplace. Is that kind of what you're looking for? Or how
Yeah. I would just, so there's a step probably between the friends and family and the angel groups. You could call them angels, just, solo angels or super angels. Can you tell me a little bit about those people and what are the different types of angels that fall into that group? And again, like what's the best way to access, you're too small for an angel group, or maybe not, but how do you find the right angel, and how do you even find the right angel group?
Right. Okay. So, because most angel groups that are like official networks, in this day and age, a lot of them require a minimal viable product, which means that you've figured out this actually works. It's not just a patent that's been filed. You actually have something that shows your idea that's on paper works, whether it's a consumer product, a tech product, whatever it might be. It's a minimal viable product. And then they want you to have market validation. They want you to, they'll pick random numbers like 100 customers or, this kind of a thing, because they want to know that you know how to go through the process of actually selling whatever it is that you've got. So to get to that point, of course, you need money. And so those angel groups, you can find them through the Angel Capital Association. Almost all of them will have on their websites what their criteria are, what their post is. There's things like Gust, where you can put in an application and push it off to a bunch of different angel groups. There's another program, I forget the actual name of it, but it's something with founders. It's like an acronym for founders. And
Founder Suite, maybe? Yeah.
Yeah. So there's a couple of them out there. I mean, Angel Capital Association is the best place to start. And then from that, you can find you Google on the state that you're in to start with for the angel groups in your state, because your earliest stage angel investors are going to invest in their backyard. They might co-invest and syndicate, and they'll go out to other angels in other states to syndicate with a deal they really like. And so one of your criteria becomes, will you help me syndicate this investment if you're going to invest in me? Because you want that other angel groups look for that lead investor to do that role. So in between, in this gap, is like, how do you get to that? That's kind of what you're talking about. So your friends and family, people call them friends, families, and fools, right? And the reason why the angel investors call them that is because they're the ones that will invest off of that emotion that I described earlier. Oh, I can't believe, and I'll tell the story.
Right.
Well, part of one of our success stories is sort of in that thing that we'll come back around to, that I'll talk about it in a minute. But a lot of times, it's that emotional, and you're just so happy that these people will give you money. And they're, what you want though in that process, when you're raising, because it's not necessarily your friend or your family. So like when companies come to me to get advice on raising capital, they usually do that because they go, look, if I had rich friends and family, I wouldn't have to come to you, Karen, to try to figure out how to do this, right? And so they don't, so it's not necessarily that direct connect. It's who those people know that can help you. And what you're looking for is really two types to start with, right? There's the professional angel that I call, and those are the people that are like professional services people. And so they will give their services in order to, in exchange for equity until you have money to pay them, or they might kind of create a bill, and they might put a little money in to, not just take equity for services. So they combine. So there might be somebody that is really good in your industry with the marketing, and they know your customer, they know your target market, they know how to do that. They can help you build that. They can help you build your web environment. And they say, okay, I'll take $2,000 to do that, and it's a $20,000 engagement, and I'll take $18,000 in warrants. Like that. So that's professional angel, okay?
Right.
And then but they don't ever get it. They don't get that till they accomplish what it was that they would have been doing if you were paying.
Yeah.
And then you have the super angel, I call them, or sometimes within that class is an exec with a check. And so these are people that have a lot of money. And you might find some of these with this current, situation where executives are getting laid off. They're getting big severance packages, and they may be sitting on, potentially hundreds of thousands of dollars in their severance package, or they also have this kind of money they've accumulated, a good bit of money in their 401k that they can move out of that during that process into a self-directed IRA. And so they have the ability to come in and put money in your company as an investor and not take a salary, maybe take, additional equity, and they're working full time or at least half time in your company, doing it as a co-founder almost, or as a founder, sort of founder light. So you get a meeting of the minds, right? Because you're not just about the money. It's like getting married, right? And I talk about this stuff in the book as well. But it's like you're getting married. So it's not just they got the money for you, but do they agree with the founder's vision of the future? Or if they have a pivot in mind, does the founder agree with the pivot that this is the market that we need to go to? And they come in with $200,000, let's say, and they're going to work in your company and take equity as a salary, because they're not just recycling the money. You're not turning around and paying them $200,000 to work for you. Companies that would come in and they go, oh, this exec from so-and-so company will come and work for me, but I've got to raise $200,000 to pay for him. I was like, no, that person brings that money with him from his friends. If he can't put that own money in, and he's just going to recycle it, then he's obligated to find the investors that's going to pay his salary, because he's so critical to the success of this company that they're willing to put money in to pay him to be there. Okay.
Yeah.
Otherwise, they're doing this because they're working themselves out of the job. So say they're going to be the CFO. They come in and they put this money in. They work with you for a year and a half on no salary, because they've got other sources of income that they don't need the money because of the other investments that they have, so that they can just work with you to help you succeed, help you raise capital, help you get your MVP, help you get to your first round of customers. And then as you start generating revenue and go get your Series A, you can hire somebody that actually will do that job, and they just now take a seat on the board of directors, right?
Yeah.
That's that super angel. I call them an exec with a check. And you find those through working your own network within the industry. If you're in the industry, if you've been in that industry for a while, you know people. You may think, oh, I went to this conference and I met all these things, or I spoke at this conference. You got business cards that you're like, yeah, I can't call that person. I haven't talked to that person in 2 years. Yes, you can. You just need to, and there's a whole process of how you don't chase after them, that you entice them. It's learning how to use your elevator pitch as a magnet, for people to want to get more information, and they qualify themselves based on the questions that they ask you on whether they're interested or not. It's how you network with that. It's a whole process that companies can use to network to find these people. And then there's, of course, LinkedIn is a great online source for trying to get access to some of these people. And you may start with them being an advisor to help you and you're selling them on advising you for no fee because they're a potential investor. And then that super angel can say, well, I like what this guy's doing. Maybe I want to be involved in it. And then the incubators, the last place to find these folks are on incubators that have really strong mentoring organizations that get involved with the entrepreneurs. You've been a part of these and the incubators that you're a part of. And so they get involved and they come to trust those founders because, like I said, it's like a marriage. So it's not just about the money. And so there's this bond that's built. And then and through that, and I see it all the time in Atlanta and everywhere else where some of these incubators that get cultivated, and they come to do the pitch of it, and you're like, how'd they get those execs? Well, those execs were mentors in the organization. And then through that process, sometimes they'll graduate out of these incubators with hundreds of thousands in investments because that person got involved and opened up their Rolodex to them. So.
Right. No, that's exactly right. So, yeah. Kind of switching gears to like just risks that, if you were to come to me and I'm an investor and maybe I'm in an angel group and you were a startup and you were to come to me from an investor's viewpoint, what are some of the risks of early stage investing? Like what are the key risks? And then how do you mitigate those risks? Like what can you do either as a startup or as an investor to try to make it less risky, take some of the risk out of it?
Well, so the very nature of startups is that it's 100% risk, right?
Yeah,
so it's
right.
Like, and if you're first money in, particularly in that early pre-Series A or the official angel group standpoint, that's why the execs with checks will do it because they get involved in the company and it's kind of like they get to oversight their money.
Right.
And so by being involved, and I know a lot of investors that it's really unique. They want to be involved and they are shepherding their money through the process and they have been involved and they know that they have the ability to raise the other money. So when if you're looking at a deal that doesn't have somebody like that and that that person that's in the company. So they just come to you because you share an accountant and your accountant says, oh, look, hey, this guy I think it's pretty cool. You should take a look at it. And you're not necessarily in a position because you do have a full-time job to be active in the company, right? So you're in that scenario. So have they gone through something that is the fundamentals of starting a company? Because even with entrepreneur programs in universities, they don't. I did a podcast the other day where we talked about. I did two podcasts on this. This ended up being a part of the conversation where it was just there's so much they don't cover about even forming the company and how many shares should you initially issue and offer when you go through your formation process with your state. The default is 1 million shares, but 1 million shares, if you're raising capital, is nowhere what you're going to need. And you're not going to have a share that's $1,000 a share. That's just ridiculous.
Yeah.
You've got to, do they go through to get the training to do the basic?
Yeah, no, that's exactly right. And you bring up a great point about incubators and, with Newchip right now, what sort of the thought process is to work with some of these VCs or groups, and as they either invest in companies or maybe they don't invest because it's too early, that that they know that we're out there, the group's out there, and they can send their first time founders, first time CEOs, companies that they invest in, or companies that they may invest in the future once they grow. They can send them to the to the accelerator basically, and they can go through a 6-month program where it's all of that information is in there. And so exactly right, that is definitely something that I think de-risks it from the standpoint of now you have someone that at least not only understands about the basics, but they kind of then, understand what the KPIs are of, their industry and what they need to do to be successful. So I completely agree with that. I mean, one of the things I know too is that as, if somebody came to you and wanted to raise like, I don't know, like $1 million, for example, and you knew that you could put in, 50,000, for example. Being an early check writer, that in and of itself is really risky. And, as even a part of an angel group, if someone came and you knew your angel group could probably put in, 200,000 or 400,000, but the person needed, 1 million, 1.5 million, there's a risk there. So what are your thoughts on that? And I know with your angel group, you've kind of put some things into place to overcome that risk.
Well, a big part of that particular point, and then I'm going to circle back around on some other ways to approach investing as an investor to mitigate your risk. But that's where escrow comes in, right? So one of the things that I always advise companies to figure out, and I tell investors on the same page on that, is that it says, if they need $1 million, so $1 million is what they think that they need. What is it that they really need between somewhere? Because it takes time to raise money. They're not going to get $1 million in a day. They're going to take it over time. So what are they going to do with that money that is going to make that rest of the money easier to raise, but also ensure that they are going to get successfully through that to the next stage? So if they need, if say it's $20,000 to do, we're talking about the MVP part of it or something like that, or they need $20,000 to do this next version of it, or they need packaging, or they need, something other than, they need to go get, let's say within, Newchip or something like that, there's, they've got a consumer product and they have to get some kind of licensing on it, or they've got to get some other kind of, approval. A lot of times, like in the electronic space, you have to go get UAA approval. There's different things that you have to do to be in the market successfully, right? And so within that, what is it? So if 200,000 is the number that they have to have in order to get to this next really critical stage, well, then you put the money as 200,000 in escrow. And then when they come back to you with that X, then they'll go put that money in. And so you've built that funnel that I was talking about, where you have these people that are working their way through to convert to investors, just like you would convert a customer. So, but it's like this strategy. And so so escrow is the best way to do that. And that way you as an investor know they're not just doing it to pay the rent. Because if they do it where companies end up failing that never really get going, is because they underestimate how hard it's going to raise money. They underestimate how long it's going to take, or they missed their message. They wasted time with investors or trying to attract investors that would never invest in their kind of a deal. And so they've wasted time is money, and they just used the money up and they didn't get stuff done. So escrow is the best way to do that. And then let me add this. So from an investor standpoint, you're looking at trying to get started with this, and you don't want to do you two ways. You say, oh, I love startups, I love innovation, I love ideas. And this is sort of a West Coast VC mentality of this. You're going to take your money and you're going to put it at really small amounts in a lot of companies. And you just use it. Just get going with it. And it's money you're okay with losing, because your next round, they're going to disqualify themselves because they're not going to get to that next level. They're not going to use that money wisely. And so, maybe you're looking at doing 100 grand. And so you're going to put 10 grand in 10 companies right off the bat, which is not, or you're going to do, 50 or 20 companies with 5 grand. Right. And you're just going to see where they get through to that next level. And then that next one, you're going to come back with 25 or 50, because out of that 10 or 20, a third of them actually got to that next level. And then out of that, another, a half of those get to that next level. So by the time you're putting big money in, they have gotten through, and they've raised money from a lot of other people.
Demonstrated that they've been able to reach these milestones.
I'm going to put money in a lot of different ones. I'm looking for a certain industry, or solving a blockchain problem with voting, right? Eventually we wanted to have everybody's IDs for driver's license, for IDs, for travel, for this kind of stuff. And how can we use blockchain to verify people's IDs? And it might become something that we could use with every vote counting. We wouldn't have to worry about this. And when it comes to traveling, we wouldn't have fake IDs. We wouldn't have, it would be, and we can do the checks and balances through that. And there's lots of different companies that are working on that. I'm going to spread my money around and see which one wins, right?
Yeah.
So you can use that as a way to mitigate risk, because you want to do that kind of thing. The other way that investors are mitigating risk, and that long time people had used SBIR grants. So that's where the government gives money to entities to develop tech that the government thinks that they need. You see it in agriculture, you see it in security, you see it in all kinds of places that the government has put grants in place, and it starts with a little bit of money and eventually gets to like $1 million or $2 million. They do the same thing. If you do this for this amount of money, we'll give you this money, and then we'll give you this money, right? And so we were working with a company that's doing this new kind of body armor and windows, because the stuff out there with our military right now, it gets all clouded up. That stuff that changes color based on daylight and stuff like that, or you can push the button and it goes dark so they can't see who's behind it. And there's all kinds of opportunities for that in the commercial sector. And so the government has been trying to help develop better technology to protect, body armor and things like that. And so whatever it might be, that's one way, because that means that full technology has been developed without any equity being given.
Right, so it's non-dilutive, which is really
right. And that's a good place to look for that kind of stuff. Similarly, out of universities. Universities will develop tech, and then they take it to market, and you license it from the university. But those entrepreneurs need people that are experienced in building a company, but they've got this tech that's developed, or this innovation, and there's all kinds of stuff that's in renewables and recyclables. There was one that we worked with that was taking plastics that are recyclable plastics and like out of carpets, and then repurposing it to be bumpers in cars. Okay. And right. So you're, things of this kind of innovation that you can take to market. I mean, look, Gatorade is one of the infamous ones that came out of innovation from a university, right? So, it's there's those kind of things where it's somebody else's money that's being used to get the tech completely developed. Now it's just putting money for going to market.
Yeah.
And the third way is with the growth of crowdfunding, reward-based crowdfunding, right? We've seen it all. The original VR masks, drones, 3D printers, fidget widgets, our smartwatches, all that stuff came to market through reward-based crowdfunding, and then the investors got involved with it. You can use the Reg CF, intrastate crowdfunding, and even reward-based crowdfunding to watch innovation coming to market that you might want to put money in and try that out. And it gets in the reward-based, it gets to market without any equity being given up. So those are. And Reg CF, typically they all come in as one entity. So it's one voting unit, and it's not something we have to deal with a whole bunch of small investors. It's one entity that's a block. And so those are some of the strategies I think investors and entrepreneurs can use to get to market. There's so many ways to do it in this current, world.
Yeah. Those are all great ways.
Communication, one of the biggest mistakes. So I'm going to do two mistakes that companies make when they're raising capital. So we just heard the good thing is communication, right? So the bad thing is when you don't communicate, because then they all wonder, or they think you're failing. They don't just assume
you just think the worst, like this company must not be doing well if I don't hear from them.
Yeah, exactly. So they're not going to go open up their Rolodex. They're not going to go talk to the VCs that they know if you don't communicate with them. And then when you're urgent, and they think entrepreneurs do this because they think, oh, bad news, they're not going to. No, they're there to help you. They're compassionate capitalists that want to help you succeed and protect their money. Okay, they want to help you succeed. So that's the communication or lack of communication. The other thing is when you're raising capital, I have this phrase that I've trademarked called the WIC statement. It's why an investor cares. Okay, so it's kind of a part of your elevator pitch. But whenever you're doing a pitch presentation, the biggest mistake that I see entrepreneurs do when they get up in these, and I've coached in my mentoring, I've coached many a company on the business plan competition, and I'm right now, I'm like, I wouldn't say 100% of the companies I've worked with have won their business plan competitions, but it's up there, okay? And it's why the whole thing, it's not a sales presentation on your product. It's not a feature function benefit of your product and why you need to buy it. You have to take, that's a piece of it, but you've got to get into the why an investor cares. Why an investor cares about what you're doing and how they're going to make money. They could care less about your thing and you. They want to know it's all about me. I'm the investor. I want to know how, if I put money into your company, how you, Mr. Entrepreneur, are going to make me money.
Right.
That's what your presentation is about.
Yeah.
And all the pieces that you talk about there is proving to them, or at least convincing them so that they want to spend time with you, what you have done to figure out that's how you're going to solve all these pieces of the sequence of getting to market and growing a company, and how you have identified the problem, how you're going to solve the problem. And if you don't know, how you're going to get help to solve that.
Right. Now that's excellent advice. And so I know that all these snippets of wisdom here that you were sharing with us. I know that you've done this in your book. I know that you've done podcasts. Tell us more about you going forward. I know that many of the things that you've said are in your book, Inside Secrets to Angel Investing. What's in the future? I mean, I know you're doing podcasts now. Do you want to tell us a little about that, or anything you have coming up?
Okay, so the first thing I want to do is my website is really simple, KarenRands.co, Karen Rands Co. Okay, so that everything is available through that, and I'm going to talk about. And so for entrepreneurs, the first thing I want to encourage you to do is just go to the website, go to the contact page. I don't have any fancy pop-ups, sign up to this or anything like that. It's like, we're all adults. If you want the information, you're going to go get it. And so on the contact page, you sign up for my Compassionate Capitalist coffee breaks. And so I started doing a series of these 2-minute videos when people, nobody has time to read all these newsletters. They got best case intentions. I knew I was always putting them into a folder to get back to, and I never get back to it. And so, but I knew that people have 2 minutes out of their day to take a coffee break, take a mental break. And when this email comes in about once a week, it's a little tidbit mostly for entrepreneurs, but also investors will learn from it because it's answering questions that entrepreneurs have. And I kind of put it into perspective from an entrepreneur perspective or a venture angel investor's perspective. And then there's a few of them that are just for investors in there. But that's an easy way to just getting drip of information that give you ideas or help you solve some problems. The second one is it's a good sign up for that. And so then my podcast is the Compassionate Capitalist Podcast, which I renamed about 10 years ago as part of that movement, the recession, getting people's money back in the market. And then I really rebooted it when I came out with the book, because this idea of angel investing, I discovered the millions of people that make over $200,000 a year, really making $300,000 a year on a W-2 as a salary. There's millions of them that are doing that, even in today's, financial crisis situation, that have never heard of angel investing. They never heard of that. I thought because of the crowdfunding and the Jobs Act, they would be all looking for that information. And so when my book, Inside Secrets to Angel Investing, unfortunately, not as many people are Googling angel investing as I thought. And the name that you would have, how to invest in private companies before they go public, or, get bought, or, be the right side of the quadrant and be a business owner and multiple, those are really long titles that, nobody would buy a book. You couldn't read the on the page, right? It'd be like all these words. And so the Compassionate Capitalist podcast became my avenue to share that message in a informed way, like almost like an infomercial. So I interview angel investors and how they got started, how they started angel investor groups. I interview successful entrepreneurs on how they built their company and then became an angel investor, how people are, the kinds of things that they're seeing and opportunities in the companies that they're building, service providers that help with marketing and branding and how you get out there to convey that, how do you integrate that, how do you legal, just everything that the two sides of the equation. How do you create successful entrepreneurs that can build, wealth and create jobs and be successful in their own right, to build a company that can scale and exit. And then the investors, how do you, best practices for investors, how do you, how do you be a part of that? And even within industries, it's a VC that does esports, right? And so how do they look at companies? I just did a life sciences coming out soon. The life sciences angel group and how they look at, because life sciences is a completely different sector than say consumer products, right? And so all of that is part of the Compassionate Capitalist podcast. And if you go to the website, you can, go to the blog page where all they're listed, and you can search on that and find a topic that you're interested in. And then, or any of them, you can just look at the platform. So all the buttons for the platforms, it's on iTunes, Stitcher, TuneIn, all that stuff is there. You can find the platform you want, or go to the platform you're already listening to them on and search on it under my name. It's easier to find sometimes Karen Rands than Compassionate Capitalist, but you can find it that way. And then that's just, put it into your queue. It's every week, Tuesdays at 2, there's a new show. All right. And then on the website also is the link to the book. If you click on about Karen Rands services, there's a thing that you can get an excerpt from it. You can get 12 of the 47 secrets that are in there that are, I think, are the 12 best secrets, about angel investing, and get that. And then when you buy the book, it's only $20. You can get access to my resource portal for angel investors. So there's due diligence checklists, sample documents, all that kind of stuff. It's part of it. And then what I'm doing now is the next book. It's scale, because there's so many companies that raise that first round of capital and then plateau. They miss that next round, and they don't know how to jumpstart their business to become that. They're a $5 million business, and they really thought they were going to be a $20 million business by then, but they didn't quite make it. But they've got these other products that they want to bring out, or these services, or they want to expand in these different ways, and they need the money to do it. And they're too wrong industry or too slow growth for VCs. They can't go back to the angels because angels want the smaller valuations in earlier stage companies, or they've got an angel round, so now they're stale. They can't go to private equity funds because they're too small. And if they want to raise $5 million or more, and they're a $5 million company, they can never go to a bank and get that kind of money. So what do they do to raise capital? And what do they do in their operations to prepare themselves to scale? And so that'll be all outlined in the next book about, inside secrets to scaling your company and getting the capital.
Like a really, it sounds like a needed, to address that. I'm sure quite a few companies find themselves in that predicament. So looking forward.
A lot of angel groups find that their portfolio, they've got, a third of their companies are like
in that sort of chasm, right, where they're in there and they're trying to raise their next round, and
they're just stuck.
No, I look forward to that. When are you anticipating that book? I'll be looking for that.
Well, soon.
Okay.
It'll definitely be before the end of the year.
Got it. Okay.
It's going through some revisions, and it took a minute to figure out how to structure all that information to be where it was consumable. Because I don't write, my books are not lightweight, as you know from getting this book, right? It's like, it's intended to be really a tool that people can use. It's not just, it's not a
lighthearted, right?
So,
Okay, well, thank you so much. And I'll definitely be tuning into your podcast. And thanks so much for your time and all your wisdom. And I look forward to it. Thank you so much, Karen. Okay.
Thank you so much, Laurie. And everybody that's watching this, good luck to the companies that are pitching, and investors, please, please think about, you know, be serious about thinking about your investments in these companies, and also be very serious about, if it's not something you're liking, to say no. It's okay to say no. Everybody's big boys and girls, and don't waste the entrepreneur time or your time in the dance. Okay.
Yeah.
Right. This courtship thing, just go. And, you know, if you know it's not going to be there, if you think maybe it is, well, take the time to be serious about deciding yes or no, or at least the next step towards a yes, so that, you know, people can get done what they need to get done.
Yeah, that's great advice. Great. Okay. Thank you so much.
Thank
And,
you. Bye-bye, everybody.